Welcome to another episode of AI 10X, brought to you by 10 Leaves.
Thank you. It's great to be here.
For today's deep dive, we are examining a really fundamental rewiring of the financial sector.
Yeah, a complete paradigm shift, honestly.
Exactly. The mission today is to unpack the mechanics of a transition that is happening right now, mostly under the surface of the global economy.
Right under our noses.
Right. We are looking at a financial ecosystem that is rapidly becoming faster, smarter, and entirely autonomous.
Which is a huge distinction. The underlying architecture of how markets operate, how capital is protected, and how institutional risk is managed, it's experiencing a massive shift.
It really is.
We are moving away from systems that are constrained by human biological limits.
Yeah.
We're shifting toward an ecosystem defined by autonomous execution. And the implications for market physics are just, they're massive.
Okay, let's unpack this, because the sheer velocity of this shift is hard to wrap your head around.
It is.
We are looking at autonomous trading systems that analyze markets and execute strategies in milliseconds.
Milliseconds, yes.
And for anyone following the financial sector, high-frequency trading isn't exactly a new concept.
Yeah, it's been around.
Right, algorithms have been executing trades rapidly for years. But the distinction here in our notes seems to be the word autonomous paired with strategies.
That is the crucial distinction to make here.
So how is an autonomous strategy formulation actually different from the algorithmic trading we are already familiar with?
Well, traditional high-frequency trading often relies on pre-programmed static parameters.
Right, like a human sets the rules.
Exactly. A human quantitative analyst writes a script. And that script basically says, if asset X hits a specific price, buy Y amount.
Simple cause and effect.
Right. It is fast, definitely, but it is ultimately a rigid reactive reflex. What we are discussing now with these new systems is entirely different.
Because it's not just a reflex anymore.
No. An autonomous trading system isn't just executing a predefined rule. It is conducting active analysis and formulating an independent strategy completely without human intervention.
So instead of just looking for a specific price trigger, like waiting for a stock to hit $50, the system is actively ingesting vast amounts of market data,
Mountains of data.
recognizing emerging patterns and deciding on a complex course of action on its own.
Exactly. It is assessing variables across multiple interconnected markets, weighing the probabilities, and then formulating a strategic move to capitalize on an emerging inefficiency.
And then executing that move.
And then executing it, yes. And it is doing all of that analysis and execution within a single millisecond.
Which is just, let's try to put that into perspective for a second. Think about human reaction times.
It's not even close.
Right. If you touch a hot stove, it takes your brain maybe a few hundred milliseconds just to realize it's hot and pull your hand away.
A literal biological reflex.
Exactly. But we are talking about a computer doing complex financial modeling in a fraction of that time, a strategy that would traditionally require a whole team of human analysts, hours or even days, to debate, model, and approve.
Getting the committee together. Yeah.
Right, having the meetings. All of that is now being conceptualized and finalized in a fraction of a second.
Which fundamentally changes the nature of market liquidity and volatility.
It has to.
Absolutely. If you have systems executing complex, multi-layered strategies in milliseconds, you are essentially removing the human bottleneck from the entire process of capital allocation.
There's no committee meeting.
None. There is no human hesitation, no second-guessing.
Yeah.
The system perceives an opportunity and acts instantly.
But see, that raises an immediate concern for me.
Let's hear it.
If we remove the human bottleneck to achieve this incredible speed, we also remove the human instinct.
Ah, the gut check.
Yes. The instinct that might look at a bizarre market anomaly and say, wait, something is wrong here. This doesn't make sense.
That is a very real issue.
How does a market operating at autonomous computation speeds keep from just tearing itself apart when an anomaly occurs?
That is the structural vulnerability of speed.
Mm-hmm.
When you accelerate the execution of strategies, you simultaneously accelerate the potential for catastrophic compounding errors.
Because the computer doesn't know it's making a mistake.
It just knows it's executing the strategy it formulated. A flawed strategy executed at millisecond intervals could drain massive amounts of capital before a human operator even realizes a trade has occurred.
Before they can even blink, the money is gone.
Exactly, which requires a parallel evolution in how the system protects itself. And that brings us to the concept of RegTech, or regulatory technology.
Which is the second big piece of our source material today.
Right. If autonomous trading represents the faster element of this financial rewiring, RegTech represents the smarter element.
Okay, let's look at the mechanics of RegTech then. The function of this technology is broken down into three critical areas according to the notes: detecting fraud, ensuring compliance, and monitoring risk.
The three pillars of financial security.
Right. And traditionally, these three areas were the domain of massive departments of human auditors, compliance officers, and risk managers.
Entire floors of office buildings dedicated to this.
Exactly. And crucially, their work was almost entirely retroactive.
What's fascinating here is that it was essentially an archaeological process.
Archaeological. I like that word for it.
It really was. Human auditors would review transaction logs and communication records days, weeks, or even months after the trades were settled,
Digging through the past.
digging through the digital dirt to piece together whether a regulation was breached or a fraud was committed way after the fact.
Right. But the operating reality now is that AI uses RegTech to perform all three of these functions in real time.
Real time.
But let's really think about what real time actually means in an environment where millions of trades are happening simultaneously in milliseconds.
It redefines the term entirely.
It does. How does an AI define fraud or a compliance breach instantaneously?
Well, the shift here is from static auditing to dynamic continuous monitoring. In a traditional setup, you are looking for a needle in a haystack after the haystack has been built.
And usually after the needle has already poked someone.
Exactly. Real-time RegTech operates differently. It continuously establishes and updates a baseline of normal market behavior across millions of data points.
So it knows what normal looks like at any given millisecond.
Precisely. When an autonomous trading system executes a strategy, the RegTech AI instantly analyzes that specific action against the dynamic baseline.
In real time.
Yes. If a trade exhibits anomalous characteristics, say, a volume spike that correlates inexplicably with a completely unrelated asset class, the RegTech can detect that deviation the exact millisecond it occurs.
So it isn't just checking a static list of known fraudulent behaviors, like it's not just looking for past scams.
No, it is actively identifying anomalous patterns that might represent entirely new forms of market manipulation.
That handles the fraud piece, but what about the compliance aspect? Because the financial sector is bound by an incredibly dense, complex web of global regulations.
It is a nightmare of red tape.
Right. Jurisdictions overlap, rules conflict, and the parameters for what constitutes a legal trade change depending on where the buyer and seller are physically located.
Geopolitics comes into play heavily.
So how does a system ensure compliance in real time without just grinding this high-speed trading to a halt?
Well, for a human compliance officer, that web of global regulations is a massive liability. It requires careful, methodical cross-referencing.
Poring over law books and policy updates.
Exactly. But for an AI-driven RegTech system, that entire global rulebook is simply another data set to be processed.
Just more data to chew on.
Yes. Before autonomous strategy is fully executed and settled, the RegTech system cross-references the proposed parameters of that trade against the relevant regulatory requirement.
At millisecond speed.
At millisecond speed. It ensures that the trade doesn't violate jurisdictional restrictions, capital reserve requirements, or client mandate limits. It acts as a proactive, high-speed filter.
Okay, this raises a really important question at the architecture of these systems.
Go ahead.
We have one set of AI systems designed to aggressively formulate strategies and execute trades to maximize returns.
The autonomous traders.
Right. And then we have another set of AI systems, the RegTech, designed to act as the police, monitoring for fraud and rigidly enforcing compliance.
The monitors.
It sounds like an arms race entirely contained within a single server rack.
It practically is.
If we are using AI to police AI, aren't we just creating a closed algorithmic loop? How do we know the RegTech monitor won't suffer from the same unseen logic flaws as the trading algorithm it is supposed to be watching?
That is the precise danger of a fully autonomous ecosystem. If the police AI has a blind spot in its logic, the trading AI, which is designed specifically to find and exploit inefficiencies, will inevitably find that blind spot.
And it will optimize its strategies around it.
Exactly. It'll exploit the monitor's blind spot without even realizing it's doing something wrong. It's just optimizing. This is why the third pillar of RegTech monitoring risk is so incredibly vital.
Because it's not just about rules, it's about exposure.
Right. Risk monitoring in this context isn't just about ensuring individual trades are legal. It is about calculating the cascading exposure of the entire institution in real time.
Let's break down that real-time risk calculation for the listener. If an institution is managing billions of dollars across multiple global markets, its actual risk exposure is a constantly moving target.
It never sits still.
If a foreign currency suddenly devalues on the other side of the planet, the risk profile of entirely unrelated domestic assets might instantly spike.
Exactly. The interconnectedness is staggering. And human risk managers cannot recalculate complex global exposure matrices fast enough to respond to millisecond-level market shifts.
It's mathematically impossible for a human.
It is. AI RegTech monitoring risk in real time means the institution's total exposure is being continuously recalculated with every single microfluctuation in the market.
So the system knows exactly how close the institution is to the edge of the cliff.
Yes, it knows how close it is to its maximum risk tolerance at any given millisecond.
Which brings us to a huge overarching question. What does this all mean for the systemic stability of the broader financial market?
That is the ultimate question.
Because on the surface, having real-time fraud detection, instantaneous compliance filtering, and continuous risk recalculation sounds great. It sounds like it should create an impenetrable, highly stable system.
On paper, yes.
But intuitively, allowing algorithms to execute complex strategies at speeds invisible to human oversight feels inherently fragile.
It feels risky.
It does. A single compounding error could theoretically wipe out a portfolio before a human operator even registers a notification on their screen.
This is the defining tension of the modern financial sector. The transition to autonomous trading and AI-driven RegTech can increase financial stability, but that outcome is strictly conditional.
Conditional on what?
The system is not inherently stable just because it is fast and uses advanced technology.
Oh.
The condition for increased stability is that these autonomous systems must be combined with strong oversight and governance.
But how does human governance actually function in an environment where the actions are taking place in milliseconds?
It's a fundamental shift in the definition of governance.
It has to be. If an autonomous system decides to execute a massive, complex strategy, my human oversight feels completely irrelevant if the trade is finalized before I can even blink.
You can't govern what you can't see.
Exactly. You can't actively govern something you can't perceive.
If we connect this to the bigger picture, the nature of governance itself has to evolve. Strong oversight in an era of millisecond execution no longer means a human manager reviewing and approving individual actions.
Because there's no time.
Right. Governance shifts from active operational control to foundational architecture.
Oh, meaning the human element isn't driving the car anymore.
No, they are absolutely not driving the car.
They're designing the track. They're hard-coding the physical limits of the engine before the car is even turned on.
Precisely. Governance in an autonomous system involves defining the absolute parameters of acceptable behavior ahead of time. It means establishing the hard-coded risk limits that the AI cannot override under any circumstances.
Building the walls it operates within.
Exactly. It means rigorous adversarial testing of the algorithms in simulated environments before they are ever allowed to interact with live capital. Human oversight dictates the strategic goals, the ethical boundaries, and the fail-safes.
And then the AI is let loose.
The AI is then granted autonomy only within that strictly defined human-governed architecture.
But if you constrain the AI too tightly with governance parameters and fail-safes, don't you effectively neutralize the speed and analytical advantage that the autonomous system was built for in the first place?
That's the catch.
Right. If the RegTech is constantly pausing trades to check human-defined boundary conditions, you lose the millisecond edge. And in this market, losing the edge means losing the money.
That is the balancing act institutions are constantly trying to calibrate. It's a razor's edge.
I can imagine.
If the governance is too restrictive, the autonomous system becomes sluggish and uncompetitive.
You fall behind the other algorithms.
Exactly. But if the governance is too loose, prioritizing pure speed and uninterrupted autonomous strategy formulation, you expose the institution and potentially the broader market to catastrophic tail risks.
The compounding errors we talked about.
Yes, an algorithm prioritizing efficiency above all else might flawlessly execute a strategy that is technically compliant according to the RegTech, but practically disastrous for the stability of the overall market.
So the RegTech AI is checking for rule violations, but the human governance framework is what actually defines whether a strategy is logical or dangerously reckless.
Yes. RegTech is a tool of enforcement. It is not a substitute for governance.
That's a great way to put it.
The AI can tell you if a trade breaks a specific jurisdictional compliance rule. But human governance has to decide whether the firm should be operating in that jurisdiction at all.
The big picture strategy.
Right. Humans have to decide whether the overarching strategy aligns with the long-term stability of the institution. We cannot simply abdicate the responsibility of market stability to an algorithm, no matter how sophisticated its real-time monitoring capabilities are.
That makes the stakes of this transition incredibly clear. The architecture of human governance is basically the only thing preventing a highly efficient, high-speed system from optimizing itself into a systemic collapse.
It is the final safety net.
Let's synthesize what we've unpacked here today. We are looking at a financial sector that has fundamentally transformed. We started with the faster element, the deployment of autonomous trading systems that have completely removed the human bottleneck.
The systems doing the active trading.
Right. These systems are not just reacting, they are actively formulating and executing complex market strategies in literal milliseconds, operating entirely outside the realm of human perception.
We then examine the smarter element required to keep that speed from becoming chaotic. The rise of RegTech utilizes AI to actively police the ecosystem in real time.
The internal monitors.
Exactly. Instead of retroactive audits, we have systems dynamically monitoring for fraud, cross-referencing global compliance datasets instantly, and continuously recalculating institutional risk exposure down to the millisecond.
And finally, we explored the critical condition for this entire rewiring, the necessity of strong oversight and governance. The speed and real-time monitoring can increase systemic stability, but only if human managers successfully transition from being active operators to being strict architects of the algorithmic boundaries.
You have to build better tracks.
Right. Now, why should you, listening to this deep dive right now, care about the mechanics of autonomous trading and RegTech?
A lot of people probably think this doesn't affect them.
Exactly. You might not be managing a high-frequency trading desk. You might just have a standard savings account, a 401k, or a mortgage. Why does an algorithmic arms race happening in milliseconds matter to your personal financial reality?
It matters because this invisible architecture of autonomous execution, real-time compliance, and hard-coded governance is the underlying operating system of global wealth.
It's the foundation of everything.
Yes, the stability of the institutions holding your capital, managing your pension, or underwriting your loans is entirely dependent on how successfully they balance algorithmic speed with human oversight.
When a market moves, it is no longer just human sentiment reacting to news. It is a vast network of autonomous systems, instantly recalculating risk and executing strategies across the globe.
A digital ecosystem.
Your financial security is tethered to the stability of that network. It is the invisible infrastructure of the modern economy.
Which really raises an important question to leave you with, something to consider as this transition continues to accelerate.
Let's hear it.
We now have an ecosystem where autonomous AI systems are formulating strategies and trading in milliseconds, while RegTech AI systems monitor those trades in real time. We essentially have algorithms rapidly reacting to the outputs of other algorithms.
Machines talking to machines.
Exactly. So when an entire financial market effectively becomes an ongoing, high-speed algorithmic conversation, what actually happens to the concept of human governance? When machines are independently strategizing against other machines, who is ultimately in control of the market?
That is a complex reality to navigate. Who is actually steering the ship when the ship is making strategic decisions at a speed we can't even perceive?
No, it's something we all need to think about.
Absolutely. The mechanics of finance are undeniably becoming faster, smarter, and increasingly autonomous, and the definition of control is shifting right along with it.
It certainly is.
This was AI 10X, brought to you by 10 Leaves.